Why the gold price will always go up. Hi guys, this is Sagar here, and today we're going to talk about why the gold price will always go up. Now, if you're wondering why, you should watch the rest of the video. But before we begin, let me tell you a story. So I think around in 2001, I was keeping track of the gold price in the newspaper, and I looked at the daily rate of 10 grams gold, and I asked my mother. I told her, gold is just 4,000 rupees right now. Should we buy some? And she said, no, it's too expensive. It's too expensive. We can't afford gold at 4,000 rupees for 10 grams. And it seemed expensive then. But wait till you see today's prices. Now let's take a quick look at the charts. We'll look at the price of gold for the last couple of decades, and let's take a closer look. So starting from 1964, it was around 63 rupees per 10 grams of gold in India. And let's take a moment to digest the the rate of change in the price of gold. And I'm going to scroll down slowly from each year, year by year, and you can pay attention to the increasing price of gold for the last decades. And as you can see, it's it's really been increasing. It did take a pause here and there, but mostly increasing, and we've gone all the way from 63 rupees for 10 grams in 1964 to 35,000 rupees for 10 grams in 2019. Now, the question that I have for you all is the price of gold really going up? Is that what's really happening right now? Let's think about it. How can there be such an increase in price, right? So what's really going on? Let's figure this out. Let's take a quick look at the gold price chart, and if you take a look at this, you'll see that it's all going up all the way until 2011, from 1978 to 2011, and then it took 3 to 6 years, I believe around 6 years pause, breather, and then it's back up. It's rallying again. So this is what it seems like going by the chart, but let me tell you what's really going on. We'll flip the chart around, and I'm going to just flip it for you right now. And what you'll see is that it's not the price of gold that's going up, it's rupee that's weakening. It's rupee that's going down. It down, down, down. Now, if you don't believe me, let's take a closer look at the way the rupee is getting diluted. And one way to know this is to just look at the rupee versus US dollar exchange rate. And I'm going to throw up a chart here, and it goes all the way back to 1947. So we can take a look, and as you guys can see, I'm going to scroll down, and as you guys can see, the rupee is being weakened and diluted against the dollar. Alright, the next thing I'm going to bring up is the annual gold report by this company called Incrementum, and they keep tracking the performance of gold against different currencies, and they keep doing detailed analysis of gold performance. And what's really shocking, if you look at the chart that I'm going to throw up on the screen, is the rise of gold or the fall of the rupee. And let's look at that chart real close. Now, if you take a look, this chart goes all the way back to 2001, and almost every other year, there has been an annual hike of around 6 to 10%, and many times I think it's touched 20-24% annual revision of the gold price. Okay, so what we need to pay attention to is the second last column on that screen, on the screen. Now it says INR, and that's what we need to focus on. But yes, you can feel free to look at the performance of gold against other currencies. There's euro, US dollar, Great Britain pound, Australian dollar, Canadian dollar, Japanese yen, etc. So you can look at all the gold performance against all these currencies, but let's focus on the INR. And 2001, it was like almost up 6%, and then 2002, 24%, and then 13%, 0.6% INR performance against gold. 2005, 24%, 20%, 16%, 28%, 19%, 23%, 31% increase in gold price against the Indian rupee in 2011. Now, if you had a fixed deposit in the bank, and if it was paying you around 8 to 10% to even 11%, you're still losing purchasing power. And that's the sad part, you're still losing purchasing power against gold. Now let's talk about money dilution. What do I mean by money dilution? Now let's say the government of India has printed 10,000 rupees till now for this year. Let's say they only have 10,000 rupees in circulation, and next year they add another 10,000 rupees to the money supply. So now India has a total of 20,000 rupees in circulation. Now what this does is, the value of, say, the first 10,000 rupees that was printed last year goes down. So what I mean is, let's say if I could buy like say maybe a PlayStation for 10,000 rupees, a PlayStation 2. Now since the government has doubled the money supply, that is, the rupee in circulation has gone up from 10,000 to 20,000 now that same PlayStation will have to be priced higher, because the original notes that I had have been diluted because there's more of them, so they're worth less than they used to be worth last year. So that is money dilution in a nutshell. Now obviously the logical question that follows is, why is every central bank in the world diluting their currency? And the reason is, it's a rigged game, and the whole point of diluting the currency is so that all the people with deep pockets, all the people who start their own businesses, they can buy assets with borrowed money, get into debt, and slowly they can recover, pay back the debt with the diluted currency. And that's why people who borrow money to start businesses, they win in this game, and the people who lose are people who save. So that's how it's rigged. And the tragedy is, this same currency dilution is the reason for price increase and inflation, and this is the exact same reason why everything around you goes up in price, be it vegetables, fruits, land, car, automobile, and you name it, almost everything is going up in price because of currency dilution. So the market is just pricing in that weaker currency, and that's why there's increase in wages, increase in the market price of almost every other commodity. Alright, that's it for today, folks. Thank you so much for watching.